class.
Yes, sir. That is the greatness, sir.
Yes, I always said faculty coming late to the class is a crime. It's not just a mistake, it's a crime. Because students from various places, they come on time, and you are late means it's a penalty on those people who come on time. So the question is not 5 minutes, 10 minutes late. The
Yes.
question is ethics. అవన్నీ బీవరాజ్ గారి దగ్గర నేను నేర్చుకున్నాను
Oh,
ప్రాసెస్.
great. Okay.
9:30 అంటే 9:30 అని కార్ లోపలికి వస్తుంది. ఒక్క మినిట్ ముందు లేదు, లేట్ లేదు. యూ క్యాన్ సెట్ యువర్ వాచ్. గ్రేట్ పీపుల్ వి లెర్న్ ఫ్రమ్ దట్.
అంతే కదా సార్. అంటే యాక్చువల్లీ టు బి ఫ్రాంక్ విత్ యూ, even if we'll delay it by 1 minute, if there are 76 participants means 76 minutes is delay. Even if the participant come delay late by 10 minutes also, it is only a 10 minutes for him. But it is multiplied by the audience.
You are correct. Perfectly said. Nicely said.
The only thing, sir, that if we have that much commitment, because here money is not the main factor, sir. The time that they are spending, the members spending their valuable
time. Precious, valuable time.
They are taking out value for money, value for their time. Exactly. That is only important, sir. Ma'am, with your permission, sir, Shirin ma'am, please.
Respected Chairman of Vijayawada branch, Godavarti Srinivas Rao, our resource person, Sri L. Jayaraman sir, and managing committee members, fellow members, very good evening to one and all. I welcome you all for the 5th day of virtual series of CPE programs on the subject private limited companies under the Companies Act 2013. Hope you have got updated on the procedural aspects involved in issue of various types of shares with the excellent deliberations by our resource person, Sri Jayaraman sir. Today, Jayaraman sir is going to deal with another important topic, provisions relating to acceptance of deposits and role of CAs in regular functioning of the companies. Before moving to technical session, I request our chairman sir to speak few words.
Good evening, ladies and gentlemen. Sir, with Jayaraman sir, with regards to him, and really we are enriched by the beautiful lectures of Jayaraman sir, and starting from memorandum of association, articles of association, and issuance of shares and everything. Now that we are into the another phase called the deposits and charge creation and like that. So as already informed by Jayaraman sir, tomorrow is going to be a bonus session for you. There is no payment for the same and also no CPE for the same also. This is for your kind information. And just now I got a message from the ICA saying that there is a I think a time lapsed by the another 4 days for the submission of your MEF form. If anybody is stuck up, not submitted their MEF for the bank empanelment or something, multi-purpose empanelment form, they can submit up to 10th of this month. This is for your kind information, and without wasting much of our time, and I hand over the proceedings to our resource person, Jayaraman sir.
And tomorrow's timing is from 3:30 to 5:30.
Exactly. I forgot to inform. Tomorrow timing is 3:30 to 5:30. In another 1 hour, you will be receiving a special link for the same. It is not the regular link, but it is a special link. Kindly be in that there is no registration that is required. You just kindly press the link and you will directly coming into the Zoom. And we have also started the next series registration process also. I think you might have received this thing is also mails also, confirmation mails from Zoom so for the programs that are going to be conducted from Monday to Thursday. That is 9 to 12. So with this brief intro, I request Jayaraman sir to kindly take up this. Before Jayaraman sir starts, a small word that because Companies Act 2013 itself becoming an uphill task, so that's why I think it is a graphical representation by sir or not. It is a mountain and hills that are kept in inside. It has been an uphill task by the resource person, and he is making us very, very easy. That's my understanding about the slide that what I'm seeing here. Thank you, sir. Over to you.
So thank you very much, Chairman sir. Thank you, the office bearers. Thank you, Shrita. And a lot of nice things were spoken about me. I don't know to what extent I really deserve. Very good evening, my dear participants, professional colleagues. So, continuing the discussion, today we will start with first acceptance of deposits by companies and filing of DPT-3 with ROC. The first and foremost thing is, if you look back history, in the original Companies Act of 1956, there was unfortunately no provision in the Companies Act regulating the acceptance of deposits either by private or public companies. Surprising. So as a result of which, what really happened was, the companies started accepting deposits left and right, left and right. There were four important reasons why deposits became a very important source of income. One, deposits were unsecured. So therefore, there was no problem for the company to mobilize any amount of deposits because they are unsecured. Second issue is there was no limits on the acceptance of deposits. So companies were accepting huge amount. When the paid up capital was, just to say 1 crore, when the paid up capital was 1 crore, they were accepting deposits to the tune of even 5 to 10 crores without any control. Third, the companies were accepting the deposits for short period of time. They were accepting to meet the extraordinary working capital or something like that. So they started paying higher rate of interest. They even paid initially 18%, 20% or 24% rate of interest. These are all the factors which led to many companies defaulting. The four reasons were no limits on the acceptance of deposits. They were unsecured. The higher rate of interest was paid. The period for which you accepted deposits were for a smaller period, shorter period. As a result, what happened? N number of companies started defaulting the repayment of interest or repayment of principal to the deposit holders. If I'm permitted to tell, a company like Nagarjuna Finance Limited, which has mobilized at that time 1,000 crores, mark my figures, 1,000 crores as deposit from the public, has defaulted. Don't you think it is a daylight, white-collar robbery? As simple as that. The poor people, they have all put the money in the companies just because they pay 3-4% higher rate of interest than the interest what we get from the banks. I always feel that if the company defaults in the payment of interest or repayment of deposits, it is nothing but a crime. It is a stabbing on the back. It's a breach of trust and confidence that the company is doing. So what happened was, when hue and cry was raised, thousands of companies defaulted. In 1974, the Companies Amendment Act was introduced and old sections 58A and 58B was introduced. And the Companies Acceptance of Deposit Rules 1975 was introduced. That was the starting point where deposits mobilized by the company were controlled. Thereafter, a lot of amendments had come, and I remember whenever any amendment to the Companies Act comes, in the parliament, they used to discuss only about deposits, not about other amendments. Fine. In this historical background, in the 2013 Amendment Act, 2013 New Companies Act, tremendous changes have been made. We will look into that very carefully. We have to start this topic with an open mind, particularly the senior chartered accountants. You first unlearn what you have learned, because our mind is filled with the provisions of 1956. The first and foremost point with reference to private company I would like to tell is, first, you please remember the very first day I told you, in the old Companies Act for a private company, there were 4 restrictive clauses. Limits the number of members to 200, restriction on the right to transfer the shares, and third one, Third one was this prohibits invitation to the public to subscribe for the shares and debentures and prohibits acceptance of deposits. But in the new Companies Act of 2013, if you observe very carefully, the fourth restrictive clause for a private company has been deleted. So now that means indirectly, private companies can accept deposits. Only thing from the members, not from the general public. So let us start with the presumption that private companies also can accept deposits from the members. Hence, the company's acceptance of deposit rules predominantly applies to private companies also, but for some exceptions here and there. So with this state of mind, we'll enter the subject. And the deposits have become very important source of finance. So in a private company, there can be 200 members. Obviously, since deposit holders also has to be members, you can take money from 200 deposit holders. I will come to that much later. So it is one of the important means of finance. Next, what is a deposit? I'll be spending considerable time on this. What is a deposit? They have not positively defined. You could have said, if it has the following features or characteristics, it is a deposit which will be covered in this section. If you try to define like that, the biggest problem will be, if you try to define like that, the biggest problem will be, we may add some features and say it is not a deposit. Therefore, what the government has done, they had tried to define what is not a deposit. What they are saying, any money received by the company as a loan or deposit or any other form is a deposit. Other than, rather we are discussing what is not a deposit rather than discussing what is a deposit. So in this definition, what happens if it is not there? What will happen? We will add some features and say it is not a deposit and try to come out of the regulatory mechanism, which will defeat the very purpose of the act. In other words, you look at the liability side in the balance sheet. Except reserves and surplus, rest are all borrowed money. Share capital, secured loans, unsecured loans, current liabilities and provisions. All of them are deposits unless you bring certain things under the exception. So we have to understand like this. First, amount received from central government, state government, local authority, statutory authority, they are not deposits. Why? I'm not talking subsidies received from the central government or state government. Amount received in the form of loan or deposit from the government, some local authority or statutory authority is not a deposit. I have found out there are three reasons. One, central government or state government may give a loan or deposit to certain companies for industrial growth and development. And when they give it, they are secured over the assets. Second, government cannot give you at low rate of interest, which the deposit rule says you cannot pay higher rate of interest. So government cannot give you at lower rate of interest. Third, government knows how to safeguard their money. They will appoint nominee directors on the board. So what the government is indirectly telling, hey, listen, we know how to take care of money. So you please regulate only money received from the members and general public. Hence, they are not deposits. So the logical reason I told you, they will appoint their own people on the board. They are usually secured and they may give on different terms and conditions, including higher rate of interest, longer repayment period and all that, which cannot fit into the deposit rules. Second, money received from the foreign governments, foreign institutional banks and all. They are also not deposits because already they are regulated by the Foreign Exchange Management Act. So there is no need to regulate once again. And the hidden agenda is we want to regulate only money received from Indians, from our people. So this is not correct explanation. So money received from abroad, it is taken care by another mechanism. So they are not deposits. Then money received from a banking company, public financial institution, same logic. A bank or financial institution, same logic. One, they are all, I'm talking loans and deposit. First, they are usually secured. And second, they will charge a high rate of interest. Third, they will have their nominee on the board. So therefore, there is no need to regulate all that. You have to regulate the money which is received from the members and general public. So in this logic, they are not deposits. Next, money received through commercial paper, because RBI guidelines are already there which will regulate the issue of commercial paper. So there is no need to regulate once again under this act. So they are not deposits. Then very interesting, money received by a company from another company. Intercorporate loans and deposits will be regulated under section 185, 186. Probably in my next session starting from Monday, those 4 days I'll be covering that. Already money received by one company from another company is extensively regulated under section 185 and 186. So they need not be regulated once again. Now, when you say company, foreign company obviously is included. So you can receive from Indian company or foreign company. If it is foreign company, I have told you, they are already regulated under FEMA. One interesting point is, he did not use the word body corporate. He said money received from another company. LLP is a body corporate. LLP is not a company. Therefore, very interesting point is, a private or public company, when they receive deposit from a LLP, it is very much a deposit. It is not exempted. Money received from LLP. Then, amount received as a share application money. Very interesting point. Please see. If what people are doing, if I receive money from a person as a deposit or loan, hell, a lot of procedures have to follow. There are some over-intelligent professionals who, what they do, they take money in the form of share application. Ask the concerned fellow to fill up the share application form, and they will not allot the shares. They'll keep the money for 1 year, 2 years, and I'll return back the money and in fact try to pay some interest. Now it cannot happen. How beautifully they say, any money received as a share application money is not a deposit with riders, provided you must allot the shares within 60 days. We saw in the private placement guidelines also, as well as the public issue guidelines, all the allotment has to be completed within 60 days. So if you don't allot, I repeat again, share application money received is not a deposit, provided the allotment is done within 60 days. So you should not refund it. If you want to refund for some reason, you please do it within 15 days after the 60 days. So within 75 days, if you don't refund, then the money, whatever you received, even in the form of share application, will be treated as deposits from the beginning. You have to comply with the provisions of the Act as if it is a deposit. So the problem is, companies are trying to find out ways and means to get resources and kind of unsecured resources, and that is hurting the government very much. So please understand, you genuinely bring the share application money, allot the shares within 60 days, excellent. For some reason you are not allotting, please refund. Is giving a gateway. Please refund within 15 days thereafter. So after 75 days also, if I still see any share application money, you may call it as share application money, but it will attract the provisions of deposit. Next, very important. In a private company, I am restricting my discussion only with reference to private company, not with public or listed company. In a private company, money received from a director of the company or relative of the director is not a deposit. Not relative of member, relative of a director. And the other day we saw who is a relative. So, the logic seems to be, in case of crisis, if the director cannot come to the rescue of the company, who will come? And obviously, director will charge a higher rate of interest. And those are all regulated by other provisions like related party transactions and all that. So, they is not regulated as a deposit. With the rules regarding period, interest, all that will not apply. So, money received in a private company from a director or from a relative of a director is not a deposit, but the rider is, this should be their own money. They have to give a declaration that it is their money. It's not some borrowed money from some member or some outsider. The declaration has to be given. to qualify for this exemption. Then, very interesting, out of the box. So we have to focus very much. I have taken special time from the chairman for this particular topic because we will see later on the punishments and the reporting structure of an auditor in his Caro report. I'll come to that all later. We are all under the wrong impression. If the company issues some debentures, then they are not deposits. No, not at all. If the company issues debentures, prima facie, don't say they are not deposits. All debentures are not deposits. There are some debentures which come within the purview of deposit. Let me read very carefully. First, unsecured debentures are deposits. So better don't issue unsecured debentures. If you issue unsecured debentures, you have to follow the rules of unsecured debenture plus deposit rules. Point number 1, don't issue unsecured debentures. Point number 2. If you are issuing secured debentures, then they are not deposits, but subject to lot of riders. First rider is, when you issue a secured debentures, you must have a first charge or pari passu charge on the assets. Is it feasible? Let us practically understand. One, when normally a private company takes a term loan from a bank or financial institution, they will insist on first charge on the fixed assets of the company. Beautiful. Practical. When this private company takes a working capital from a bank, they will have first charge on the current assets of the company and second charge on the fixed assets. So when the company usually gives debentures, they will give a third charge on the assets. All that is not feasible. Now, what is he saying? Hey, when you issue debentures, it should also have first charge on the assets along with the banks or financial institution. Which bank or financial institution will agree? Only one small rider seems to be that it is not the book value of fixed assets. On the market value, you can take a charge. So therefore, not all the secured debentures are exempted. Secured debentures having first charge on the fixed assets only are exempted. Of course, one concession is they allow market value of the fixed assets. Another point is intangible assets will not qualify for creating a charge. Intangible assets which are of recent origin like patent, trademark, copyright, software, brands, marketing rights, they are not fictitious assets, even though intangible. That assets valuation is a big issue. Therefore, that assets cannot be taken to create a charge for the purpose of exemption under the head of secured debentures. See how much riders are there. So if you just call it a secured debenture, don't say they are not deposits. If you comply with all that only, that secured debentures is exempt. What about the other secured debentures? They will acquire the character of the deposit and you have to follow the deposit rules. Next step. What about convertible debentures? Unsecured but convertible debentures, no problem. So convertible debentures, if they are converted within 10 years, they are not deposits. So then what is a deposit? Straight away, unsecured, non-convertible debentures are very much deposits. Or even convertible debentures, if you convert into shares after 10 years, they are very much deposits. Of course, the amount raised for stock exchange is only, we are not talking of public companies, so we can leave it. Only for public and listed company, unsecured and non-convertible debentures are all exempt, not treated as deposits. So this you can forget it. So for a private company, if it is non-convertible, unsecured debentures, they are very much deposits. Then amount received from an employee. Now previously in the Companies Act, any amount received from employee as security deposits were not treated as deposit. Now there is a lot of rider. Why do you take money from an employee? There are some type of employment where we want some security, cashier job or this job where he deals with the money or goods and all. We take some security from the employee. And that money which you take from the employee, they are not deposits, not exceeding annual salary and non-interest bearing. So if you pay interest to the employee on the security deposit, it will come under the regulatory mechanism. Now, which employee will give you without interest? So all that will be regulated. So only money received from an employee up to 12 months and up to the annual salary, and they are not paying interest, then only it is not a deposit. Next, amount received in trust. Earlier it was in trust or transit. They have made it amount received in trust. Then let's now start the real game. We are all under the impression that when we sell some goods or render services, we take some advances. And they are all business advances. And we also take some advance from the dealers, distributors, wholesalers, retailers, and other market intermediaries. And we all take a stand. No, they are not deposits. No, look at the wording. You take money from the customers, from the dealers, distributors, everything as deposit, but the contract should be completed within 1 year. You supply the goods, render the services within 1 year. After 1 year also, after taking the money, if you have not supplied the goods or rendered the services, you must refund that money. Another 15 days time is given. So, advance received from the customers or market intermediaries lying with you for 365 plus 15 days, 380 days. Thereafter, this money will be treated as deposits. So this loophole also they have plugged it. Unless, of course, it's a disputed debt. Then, advance received on consideration of immovable property. You might have land, buildings, plant and machinery, something, maybe huge quantity, you want to sell it in the market. You finalized an agreement of sale, you received some advance. Yes, any amount you can receive. Then the time period of 365 days is also not preferred, but it should be under an agreement. But nowhere he said it should be writing and registered and all. Your money should be received for immovable property under an agreement. Then fine, you can keep the money for 2 years or 3 years also. The limit of 365 days is not there. Next, advance received under long-term projects for supply of capital goods. Suppose you are a big infrastructure company, a private company. You set up some projects, turnkey projects, something like that. You set up the plant and machinery for other companies. Naturally, you'll take advance from them. Then how much advance? Any amount you can take, and the contract need not be finalized within 1 year and all. Fine, you can take those advance. Then security deposit for the performance of contract for supply of goods and provision of services. Sometimes I have a contract with the client where continuously I have to perform services or supply the goods. In such case, I will take some security deposit, any amount, any period. It is not a deposit coming with the control mechanism. If any amount received above becomes refundable with or without interest, because the company has accepted the money does not have necessary permission, the amount shall be deemed. Hey, sometimes what happens, you have taken some deposits subject to the approval by some statutory authorities under which you are controlled. For example, Reserve Bank of India approval is required for some NBFC companies, or for insurance companies, IRIDA approval required, or let us say this airport related companies or airlines related companies, International Airport Authority clearance is required, and they have not given the clearance. Then you may take a stand. No, sir, I have taken all this money thinking that I will get a clearance. They have not given the clearance. No, if they have not given the clearance, it will acquire the character of a deposit. It is the risk with which you have taken. It will acquire the character of deposit. Then advance for providing future services in the form of guarantee, warranty, maintenance contract. See, nowadays we talk for continuous services or warranty for 4 years, 5 years and all. If something goes on, we'll repair. For that, we'll take the advances. In that case, the contract has to be finalized within 5 years or as per the business practices, whichever is less. Then advance received and allowed by a sectoral regulator. So SEBI has allowed it or IRDA has allowed it, fine. Then advance for subscription towards publication of print electronic. Very interesting. Today, all the companies survive on advertisement publicity to sell their products and services. Now, there are certain companies which totally have to depend on advertising. What about those companies which are providing the advertisement services? There are a lot of companies. So they book the slot in the newspapers as well as the electronic media, TV media, radio and all that. They keep with them. So naturally, some companies, to avail large scale discounts and all that, they pay advance to these advertising companies. They pay advances for 10 years, 15 years, so that regular advertisements will be released to them for them and they will get a cheaper price. Fine. These are not deposits. Then money brought in by the promoters. Listen, promoters are directors. Directors, you leave it. Some promoters, if they are brought in money, unless they are a director means leave it. Promoters, they are brought in money. Money brought as unsecured loans from a promoter automatically will not go in the exemption of deposit. Look at the riders. Money was brought in by the promoter. Why? The company is taking, the private company is taking some additional term loan from a financial institution, not from a bank. And the financial institution, they said, okay, total we'll give 5 crores. But no, they said, we will give you 4 crores. Let the promoter bring in 1 crore. In pursuance to such stipulation, the promoter should have brought in the unsecured loan of 1 crore. And the money should have been brought by the promoter themselves, not from relatives, friends. And so long as the loan is subsisting, it will be exempted as a deposit. And tomorrow you return back the money to the financial institution. This you have to immediately return to the promoter. Otherwise, it will acquire the character of a deposit. Then Nidhi companies, chit funds, they are all properly regulated. Collective investment schemes, money received, they are not deposits. Then startup companies, particularly startup companies, you can take up to 25 lakhs in the form of convertible note because they are already regulated by RBI, they're not a deposit. Then money which you get from these investment funds, venture capital, mutual funds, they are not deposits. And if you are a NBFC company or banking company or housing finance company, you are already regulated by RBI. So these will not be applicable to you. So we spent quite a lot of time trying to understand that these are not deposits. So when a case is filed against you that you have accepted deposits, because the figure is available in the liability side in the balance sheet, the onus of proof rests on you that you have to prove that this item comes under this exemption, any of these exemption. Otherwise, it will acquire the character of a deposit. Having told this, what is not a deposit, we will now see how much deposits a private company can accept and from whom. First, acceptance of deposit by a private company from the members. This you have to put very clearly sink in your mind. You can't accept deposits from the general public or anyone. You can accept deposits from the members. How much you can accept from the members? First, ordinary resolution general meeting has to be passed. You cannot bypass the shareholders. Ordinary resolution, because interest is payable, it's a charge against the profit. So, I mean, the dividend is an appropriation. So, shareholders are definitely affected the more you take the debt. So, shareholders' approval is required. First, these are the latest rules. Don't read some old books and get confused. These private companies can accept how much? 100% of the paid up capital free reserves and securities premium. Fair enough. Your paid up capital is 1 crore. You take deposits, another 1 crore. Fair enough. Don't always do business with creditors' money. Fair enough. 1:1 equity, debt equity, 1:1. You please take. So come to the first point. Any private company take from the member. From the member. 100% of the paid up capital free reserves and all. Second point. In case of a private company, which is a startup company, they can accept from the members any amount for 10 years from the date of incorporation. Previously, it was 5 years. Now they have amended and made it 10 years. Fair enough. You are a private company and you are a startup company. Not necessarily a limit to 100% of paid up capital. If your paid up capital is 1 crore, you take 5 crores, 10 crores, doesn't matter. But for the first 10 years after incorporation. Third, a private company can accept deposits without any limit if the 3 conditions are fulfilled. It is not an associate or subsidiary of other company. It's a pure private company. The borrowings from the bank's financial institutions is less than twice the paid up capital or 50 crores, whichever is less, and the company has not defaulted the repayment. What is he saying? Any private company, pure private company, public money should not have come inside. You're not a subsidiary or associate, and you are borrowed only debt equity is not more than 2:1. You are borrowed only not more than twice the paid up from the capital and free reserves. And second, even in that borrowing, you are a law-abiding company, no default. Then he says, any amount you can accept from the members. That's all. Once again, let us now summarize and bring all the 3 points together. Startup company, any amount for the first 10 years that you live it. Rest all private company, 2 categories. Very, very small private company, and you are not taken more from the bank's financial institutions, not exceeding 2:1. You are no default. You take any amount from the members. But remember, it is a deposit. It will come within the regulatory mechanism. Only concession is any amount you can take. On the other hand, if the 3 conditions you are not fulfilling and you are a private company, you can take up to 100% of the paid up capital free reserves. That's all. No other confusion. You can take deposits from the members. Startup company, any amount for 10 years. Very, very small companies who are complying with all the 3 conditions, law-abiding conditions, any amount you can take from the members. But if you're not complying these conditions, private company can take up to 100% of the paid up capital, free reserves and securities premium. And once you have accepted these deposits even from the members, DP3 has to be filed with ROC. Don't be under any wrong impression that DPT3 need not be filed. I'll come to that much later. Next. What are the other? Once you have taken money from the members, you come under regulatory mechanism. Maybe some of the rules will not apply. That filing the DPT1 with ROC, publishing the newspapers, credit rating, those things will not apply. But what are the other rules? If you take deposit from the members, then what are the rules which will apply? I'm not talking exempted deposits. If you have taken deposits from the members under any of the 3 categories, what are the other provisions also you have to comply? The repayment and all should be done strictly as per the terms. If you fail to repay, any deposit holder can go to tribunal. Hey, you cannot go to the tribunal and argue, sir, it is unsecured deposit, basically. So therefore, where is the remedy available to deposit holders? In the event of liquidation, we'll pay accordingly. No, special remedy is available. You can't argue before the tribunal, sir, they are unsecured. Tribunal will say, yes, I know unsecured. But still they'll give a direction. What direction? Where are your assets? Sell all these assets. Pay this deposit. Pay the interest before so-and-so date. Extraordinary power. Any fellow can go to tribunal and tribunal will give a direction. And you don't comply with the direction of the tribunal, then terrible damages are there. Third, application. Then this deposit repayment reserve also has to be created. Deposit repayment reserve. So you have to create it because that provides for liquidity, even for private company. Then the deposit repayment reserve should not be used for any purpose other than repayment of deposits. What is the period for which you can accept deposit from the members? 1,000 times I'm repeating. Though you are accepted the deposit from the members, they come within the definition of deposit. So the other rules you have to follow. The period is from 6 months to 3 years. Less than 6 months, you cannot accept. You are not doing banking business. But in case of certain emergency means to meet certain short-term requirements, you want to accept between 3 months to less than 6 months, you can accept up to 10% of paid up capital in free reserves. But less than 3 months, you cannot accept it. Then, what is the rate of interest you can pay? Rate of interest which you can pay on deposits shall not exceed the NBFC rate of interest permitted by RBI. At present, they have permitted 12.5%. This is only rate of interest you can pay. Of course, in a private company, you cannot appoint brokers, so no question of payment of brokers, brokerage, all that will not arise. So when you are taking deposit from the members, you cannot appoint brokers, so no other payment can be made. Then, once you have accepted the deposits, you should not change the terms and conditions detrimental to the interest of deposit holders. You should not change the terms and conditions. For example, today, the interest rate is 12.5%. I have accepted deposits. The company has accepted from the deposit holder. And tomorrow, the RBI reduces the rate of interest to 12%. You cannot change it for this period of 3 months because detrimental. On the other hand, the increase in the rate of interest, that is permitted, that is beneficial to the deposit holder. And then, very surprising, usually deposits are unsecured. But if you want, you can issue secured deposits. Many of us do not know. If you want, you can issue secured deposit. But usually we'll write deposits are unsecured. When you go for a combination of secured as well as unsecured deposits, the unsecured portion should not be more than 50%. Or secured portion should be more than 50%. In other words, just to confuse the deposit holders, you cannot issue 80% unsecured deposits and 20% secured deposits. Secured deposit should be at least 50% or even more. And once you create a security, the charge and all has to be created and filed with ROC. And you have to maintain one register of deposits. Even private companies, when they have accepted to the members, register of deposit containing all the logical details, PAN number you have to take from the deposit holder, then particulars of the nominee, deposit number, date, all those details, you have complete details. What is the interest you have paid? What is the tax deducted source? When is the due payment? If it is secured, what is the charge you have created? All those details. And the entry should be passed within 7 days. You have to update that register. And the register is treated almost like part of books of accounts. So you have to preserve it at least for 8 years. Now, this is another important point. I told you just now, a private company can accept deposits from directors and their relatives. And they are not deposit, they are exempted. However, even though they are exempted, those details are to be given in the financial statements. How many of us are looking into this? They are punishable sections. So when the private company receives money, deposit from the director or relative of the director, in the balance sheet, P&L account, in notes on accounts, those details are to be given. They are very specific about it. Penal rate of interest. If you don't pay the regular rate of interest and you default, apart from the regular rate of interest, 18% rate of interest for the overdue period also has to be paid, whether the deposits are secured or unsecured. Now come to filing of DPT 3. I'll spend some time. Many chartered accountants, company secretaries are confused with this form. The form name is DPT3. The DPT3 form has got 4 parts. We'll call it 4 radio buttons. 4 part. I'll explain very clearly. Please follow. 1. Radio button 1, that is first part of DPT3. This is a one-time return. All the companies have to file, including private companies. Whether they accept a deposit from the members or not, they should file. DPT3, first radio button, one-time return. Government would like to see your financial position. And the particulars which you are to file is in respect of 5 years. 1/4/14 to 31st March 19. So all these details, whatever is there, you have to file from the balance sheet. That is radio button 1. I'll come to that much later. Then radio button 2 is return of deposits. Radio button 3 is exempted cases. Radio button 4 is when you have particulars for both the second and third. Let me start with the DPT3 first radio button. As I told you, every company other than government company, whether private or public, one-time return you have to file, more particularly about the deposits not considered, all those details from 1st April to 31st March in DPT3 within 30th September 2019. Now we are in somewhere in November 2020. This form should have been filed on or before 30th September 2019 and no filing fee for the first radio button. But don't worry about it. In the registrar, assistant registrar on the first day was telling you, now you got a company's fresh start scheme, CFSS scheme 2020. Any old return you can now file within 31st December 20. Now you got time. So I request all these private companies and even public companies who have not earlier filed this DPT3 first radio button, you have to file it now. For the period 1st April 14 to 31st March 19, 5 years. And no filing fee for this. First radio button, no filing fee. So one-time return. One-time return. If I've already filed, forget it. That's all. And this should be supported by auditor certificate, not audit report. Certain figures he has to certify. Over. Private company, DPT3, first radio button, one-time return for 5 years. That has to be filed with ROC before 30th September last year. Because of the CLS scheme, now if you are not filed, please file it. One time, no filing fee. Over. Radio button 1 is over. And one more controversy in this. Suppose the particulars in the radio button 1 itself shows nil. Should I file the nil return? 2 ROCs in conferences I've seen. 2 ROCs are taking 2 different stands. ROC Hyderabad says, if there's a nil return, you don't have to file DPT1, that DPT3, that radio button 1. But ROC Bangalore says you have to file even nil return. My opinion is, anyhow, there is no filing fee. Last date has been extended because of the CFSS scheme. So if there's no particulars, better file it. What do you lose it? So the first radio button is so second. DPT3 radio button 2. This DPT3 radio button 2, who has to file? Any company which has accepted deposits, real deposits from on section 73 and 76 should file. This has to be filed every year with filing fee. And usually you have to file within 3 months from the end of the financial year. But this year, because of COVID, they have extended up to December 2020. So take advantage of it and you file it now. Along with the filing fee has to be filed. Here also auditor certificate has to be enclosed. Now come to a private company. Are they required to file this radio button 2? Yes, if you have accepted deposits from the members. Those three categories, startup company or company 100% or company, private company, any amount. Radio button 2. Radio button 3. At the start of this session, I talked about exempted deposits. Exempted. Money received from the director, money received from the central government, all that list of exempted deposits. If you have got, you should file. None of the chartered accountants are doing this. DPT 3, radio button 3, you have to file. What you have to file? Particulars of transaction not considered as deposits. That also you have to file within 30th June, extended up to 31st December. That also filing fee you have to pay, and along with the auditor's certificate. Now, suppose a private company has taken deposits from the directors as well as members. Radio button 2 will apply because you have taken from the member. Radio button 3 will come because you are taken from the director. But the problem is, when you open the radio button after radio button 1, any one only will open. Radio button 2, radio button 3 or radio button 4. Now I have got entries to be filled up for both radio button 2 and 3. Then in that case, fill up radio button 4. Radio button 4. Now I'll explain this once again. Radio button 1 is a one-time return. All private companies you have to file. Nil returns also you file. One-time return over. Then you have got only entries where you accepted deposit from the members and there is no exempted deposit. Just file radio button 2. You have not accepted deposits from the members, but you have got some exempted deposits, file radio button 3. You got both. In my given example, what I told you, you got both. You have taken some deposit from the members, you have got some exempted deposits you are taken from the directors. So entries will come for both 2 and 3. Then you file in button number 4. Over. That is the reason only one of the button will open. Without understanding this, much of the chartered accountants and company secretaries are getting confused. And if you don't file this DPT 3 now for even private companies before this 31st December, the consequences are going to be terrible. The story is not over. Now the real story begins. If you see the Caro report, the statutory auditors who are auditing private company, the Caro report you have to certify whether the company has complied with the directives of RBI. 3 points you have to certify in the Caro report. The provisions of section 73 to 76, whatever is applicable, whether the company has complied. Over. You are certifying the atom bomb, nuclear bomb. 2, if any order was passed in these sections by the STOIL, CLB or NCLT or RBI or court, give those orders. 3rd, whether those orders have been complied with by the company. If not complied, what are the contraventions? Challenge. Manak section what we are certifying. The story doesn't end there. Punishments. Ade marchledu ee madhya. The punishment, if the company accepts on 73, 70, including the DPT3 not filing, the company punished with fine 1 crore, no mistake in my figure, or 2 times, whichever is less, 2 times of the violation of the deposit, which can go up to 10 crores, company fine. Then every officer in default, imprisonment. Kidnapping kuda 4 years imprisonment. The officer imprisonment 7 years and fine, non-compoundable offense, minimum 25 lakhs extending to 2 crores. Muniki potad ante. And because you are certifying the DPT3, You can also be booked under conspiracy, the auditors. Story doesn't end there. If the officer of the company has contravened the provisions knowingly to deceive the company, shareholder, creditor, or tax authority, it will be treated as under 447. Enter the 447. It will be treated as fraud. At minimum 3 years to 7 years imprisonment. So stringent provisions if you violate these sections. Okay, to what extent auditor will be punishable, I'm not going into that. But if the officers and companies punished, the axe falls on the auditor. They will say, you should have told us. You should have reported it properly. Auditor will be punishable because he has not reported. Inka story avaledandi. See, many of us do not know if the violation of section 73 and 76 continues, other sections you cannot do certain things. Section 63 law, he says, bonus shares cannot be given. Where are we looking at all this? Where is time for us? Whether time is there or not, you must know all this. You can't issue bonus shares if the violation is continuing. And section 66, reduction of capital, yesterday discussed, when you go to tribunal, they'll throw the application if there's a violation continues. Section 70, which I discussed yesterday, buyback of shares cannot be done if the deposits violation is continuing. And the most important point is dividends cannot be paid under 123 if the deposits are pending. The violation is pending. And under 164 2B, we'll discuss much later. Disqualification of directors, if the deposits are not repaid, it will lead to disqualification and vacation of office of director for 5 years. See the linkage involved. That is why I took special permission from chairman not to speed up this particular topic, to go very detailed in that. See the connections. See the connections with other provisions. Last story, still I have not finished. Class action suits. Now, I'll discuss very much in detail when I go to the topic. Just as a reference, I'm telling you, why in Satyam Computers, LIC alone lost 1,000 crores in terms of fall in market value, a public financial institution. Now, LIC, they can take action against the company, but in class action suits, forget the legal entity, forget the company. The members and specified members and deposit holders can directly sue the directors along with the company. Directors matrame kadu, auditors, consultants, and other persons. Forget the legal entity, class action suits. I am telling you, if the Satyam Computer fraud has come in the present Companies Act, LIC can take direct action to sue for not less than 1,000 crores. They can file a case against PwC. And they can recover the money directly from PwC. Please read. Not less than 100 depositors or 5% of the total number of depositors, whichever is less, or you hold 5% of the total deposits, that the opinion management of the affairs is conducted in a manner prejudicial to interest of the company and members, you can file to the tribunal seeking orders for damages against the company and directors for fraudulent unlawful conduct omission, Rende, Mire, the auditors, including audit firm of the company for improper misleading statement. Misstatement and japledu, but language only. Improper, misleading, made in the audit report. I have seen a friend of mine saying, he said, there's, in the Caro report, you have to say whether the company is maintaining fixed asset register. What you have to write? The company is maintaining fixed asset register. If they're not maintaining, the company is not maintaining fixed register. Either trial apart from the two. This fellow, using lot of language, he says, the company is in the process of maintaining fixed asset register. And bearing unforeseen circumstances, Yendra reporting idi. So చెప్తున్నాడు వాడు improper misleading statements or in the audit report or fraudulent, unlawful, wrongful act or conduct. Auditor plus the expert, advisor, consultant, everyone will come here. So the point why I have included here is so if you violate all these provisions, as a result, the deposit holders, the specified people have incurred loss, they are directly going to sue not only the company director, they are going to sue the auditor and other consultants. So you have to go through this very, very carefully. Of course, when you are suing the auditors, the firm PwC plus only those auditors who are responsible for the fraud can be sued, not the other auditors. Probably in that Satyam Computers fraud, Gopala Krishnan and Srinivas, only those two fellows can be sued, not others. This is all my story regarding acceptance of deposits. I will now move on to the next topic, charges. A lot of changes have taken place here. Now, most of the chartered accountants are familiar with this topic. You all know when the company takes term loans or working capital from banks and financial institutions, they are to be secured over the assets of the company. And two types of assets are given as peculiar security. One is fixed assets on which fixed charge is created. Second one is the current assets on which floating charge is created. The peculiarity of the fixed charge is the possession of the assets is still with the company, ownership is transferred through documentation. The other peculiarity in the current asset is floating charge, very ambulatory. Both ownership and possession are with the company, the assets. Then what is the control by the bank or financial institution? Through documentation, through reports, they control. So this the charge is a lien created on the assets. It includes a mortgage. So when I say charge, it's a process of creating a security. So quickly running to fixed charge is a specific charge on a particular property capable of being identified. It can be created on present and future property. Please know, suppose my existing fixed assets are say about 2 crores. Now I am taking term loan, another 10 crores. Now another 10 crores I'm going to use to purchase the fixed assets. So when we give a security to the bank or financial institution, we'll cover not only fixed assets of existing 2 crores, but also the 10 crores which you are going to purchase from this 10 crores loan. So that's how on the future property also you create a charge. Then we normally fixed charge is created on all these fixed assets. But you can create a fixed charge on current asset also, but there's a problem of control. Then fixed assets are subject or remain in possession, and fixed asset fixed charge is easily enforceable. If you don't repay the loan and all that, the bank or financial institution will bring a lorry. If it is a movable asset, he'll put in the lorry, sell it in the open market and go. If it is immovable property, he will seal the whole factory and building and sell it by auction. So compared to the floating charge, fixed charge is very easy to enforce. Floating charge is a peculiar kind of security, floats over the assets. And the security will change. Raw material will become work in progress, finished goods will become again cash. It goes into the cycle. So the control by the bank will be only through documentation. That's why we insist on stock statements on a regular periodical basis. Right. Crystallization of floating charge. You would have heard all this. You should have read also this. Fixed charge can be directly enforced, but floating charge cannot be directly enforced. The floating charge has to be converted into fixed charge before enforcement. This is called crystallization of charge. So the floating charge has to be converted. So when the floating charge becomes converted, when the company goes into liquidation, ceases to carry on the business, default is made. So directly you cannot enforce. Once it becomes converted to fixed charge, it's called crystallization of charge. then you can enforce it. Then the problem in the assets is the possession, both the cases, is with the company. They may misuse it. So the law says very clearly that creating a charge is one part of the story. Registering the charge with the ROC is another part of the story. Once the charge is registered with ROC, it becomes a public document, and indirectly it beats a notification to the general public that the property is subject to charge. So creating charge is one issue. All these charges, once created, has to be filed with ROC, is second part of the issue. What are the details? How you should file? You know, every company creating all the charge in the assets in India or even outside India has to file with ROC in form number CHG1 within 30 days of creation of charge, along with the instrument creating the charge and other particulars. You have to file in this with ROC within 30 days. Now, a lot of changes have come. Please, 2nd November 18, if the charge is not filed with ROC, for any reason, if the charge is not filed with ROC within 30 days, another 30 days, ROC will give you time. And in another 30 days, you can file with additional filing fees. If your normal filing fee based on your authorized capital, let us say, is about 500 rupees, then he will charge proportionately 1,500, 5 times, 4 times, up to 11, 12 times he will charge. You can file it. So 30 days, only one filing fee. Subsequent 30 days, the 31st day to 60 days, additional filing fee. For any reason you are not filed the charge for registration within 60 days, for another 60 days, you can still file with payment of ad valorem fees. What is this ad valorem fee? The fees which you have to pay is based on percentage of the fixed asset value for which the charge is created. My God, I think it is 0.02%. In other words, the charge value is about 5 crores. So 0.02%, it comes to some 50,000 or something like that. Please check out. That is ad valorem fees. Let's now come back. Please file within 30 days, only one filing fee. 31 days to 60 days, additional filing fee. From 61st day to 120 days, ad valorem fees you have to pay. Now the story is, many of you do not know, after 120 days, you can't file the unregistered charge with ROC. Previously, we used to go to central government. All that has been removed. No going to central government, no going to tribunal. Many of us do not know these recent provisions. Then what shall you do? Banker has to cry. Financial institution has to cry. The only solution is create a new document, create a new charge, and do it. So the provisions have been tightened. First 30 days, filing fee, normal. 31 to 60 days, additional filing fee. 61st day to 120 days, ad valorem fees. After 120 days, go to hell. Sorry for the language. That's it. No question of giving an extension of time by the central government or tribunal, which was there earlier. Those provisions have been removed. And if the application for delay, even for this ad valorem fees and all that, it should be signed by a declaration that the filing will not affect the rights of the creditors, intervening creditors and all you have to give. And the application, the registrar must satisfy that there is sufficient reason why they are not filed within the original period. Effective safeguards. Only then registration will be allowed. And charges for property outside India also has to be filed within this 30 days. Good. This is a clarification. Subsequent registration shall not affect the right. See, Within 30 days, if you register the charge, the registration will take retrospective effect from the date of filing. But if you file from the date, so from the date of charge, not the date of filing, from the date of charge, within 30 days, it will take retrospective. Suppose I pay additional filing fee, ad valorem fee and file it, don't bother. The charge is deemed to be registered from the date of creation of charge. No way it is going to be affected. Then a certificate of registration also will be issued by ROC once you register the charge, and that is conclusive evidence of what the provisions of the Act relating to filing has been completed. One certificate of registration of charge will be given by ROC. Then, application by the charge holder. You all are aware, if the charge is not filed, who really suffers? The bank and financial institutions suffer. So a provision is given, if the company fails to file, the affected party can also file. So within the 30 days, the charge holder do not file. Registrar may allow the registration by the charge holder. He can also file it. And not only he has got powers to file it, he can recover the fees, additional fees, ad valorem fees, which the bank financial institution has paid to the registrar from the company concerned. There is only one provision where outsider also can file the charge to protect his interest. Date of notice of charge. Where a charge is created, any person acquiring is deemed to have notice. So any person giving term loan or creating an asset has to go to ROC, verify the file, and whether he has verified or not, suppose he has given further term loan on a property which is already charged, that is his funeral. So the section says very clearly, once the charge is registered with ROC, it is a public notice to the outsiders and other banks, financial institution, that this property is subject to charge. Company also has to maintain one register of charges in CHG 7, and the entries has to be made forthwith in that. Then it should be signed by secretary director, and it is a permanent register you have to preserve for 8 years. It is open for inspection by any member, creditor without fees, other person on payment of fees. Let's move on to modification of charge. Just as you file for creation of charge, you have to also file the same form if some terms and conditions are modified. The modification also has to be filed within 30 days. Any variation in the terms of agreement, variation in the rate of interest, all that. Even the rights assigned to a third party will be regarded as modification. Modification also has to be filed within 30 days in that CHG1. What are the examples of modification? Variation of terms and conditions, enhancing or decreasing the limits, ceding a pari passu charge. Prior to this, come on, you had the only first charge or second charge. Now you are allowing another person also to have pari passu charge along with you. Those are all modifications. Change in the rate of interest, repayment schedule, all the modifications also has to be, and release, a partial release. Satisfaction will be filed only when there is a total release. These are all examples of modifications. So similar to registration of charge, when you file it, ROC will give a certificate of modification, and that is also conclusive evidence the provisions of the Act has been complied with. But modification can be filed only by the charge holder, not by the bank or financial institution. Then comes your satisfaction of charge. Satisfaction is cancellation, reverse. When you are repaid the term loan in full or satisfied in full, you withdraw the charge. The assets become free, is known as satisfaction. So satisfaction has to be filed in this CHG 5. That also has to be certified within 30 days. Now the climax. For some reason, the bank financial institution is not bothered because they received their money. So the company, by mistake, they are not filed within 30 days. Next additional filing fee, another 300 days is available. another 10 months is available. So within the 10 months with the additional filing fee, you can file. Who's the satisfaction? If within that next 300 days also you're not filed, you can go to central government and they will extend the time. So this facility of the central government is there only for satisfaction. It's not there for creation or modification. So the requirement to send show cause notice to charge holder on receipt has been dispensed. See what happens, generally the satisfaction when you file, we will insist on a letter of satisfaction from the bank or financial institution. Why? Tomorrow by mistake, the satisfaction is recorded. The affected party will be the charge holder. We don't want that situation to happen. So what we do, we take a letter from him. That letter is not required if the form is signed by both charge holder as well as the, both by the company as well as the charge holder. Then sometimes I have seen some very peculiar situations. The banker, after the payment is made, he won't give the letter. He says, go to hell. You don't have to go to hell. You know, if you can provide proper evidence to the registrar that the debt has been paid in full, and he himself can unilaterally record the satisfaction. So these are all the new provisions. And despite the fact no intimation was received from the company or from the charge holder, doesn't matter. Unilaterally, he can release the property. Then ROC also has to give certification of registration of satisfaction, all that. Now, just as the company keeps a register of charges, the registrar of companies also will keep a register of charges in respect of each company. So that is open for inspection. These particulars in MCA portal, if you go there, you will get it. So it is open for inspection on payment of fees. So today, if any bank financial institution, they want to give term loan or working capital, they have to go to ROC, verify the register, whether the property which they are talking is already subject to charge. So this work is done now by chartered accountants and company secretaries. That is, the delegation is given to them. So you have to verify and you have to be very careful when you give the certificate. Rectification of register. So this is what I was telling. So central government can rectify the register of charges, not for, so you can go to central government not for delay in filing or modification, only for satisfaction. You're not filed within that extended period of 300 days also, then you can go to central government and payment of fees and they are satisfied. The omission was not purposeful, then they can give you more time extension. Or there was some misstatement in the particulars of charge or modification, those corrections can be made by the central government. And they will also give the time limit within which it has to be rectified, all those details. But you have to prove that this delay was all accidental before the central government. Then you have to file for rectifications also, right? Consequence of non-registration. Sir, one charge which has to be filed has not been filed. What are the consequences? Will the debt itself become invalid? Will it become ultra-virus debt? Let's see. If your charge is not registered, the debt does not become invalid. Debt is valid. The debtor-creditor relationship will be there. But only in liquidation, if the registered charge is not there, the liquidator will throw the document and you'll be treated as unsecured creditor. That's all. That's the first consequence. The charge is good against the company and becomes payable. So long as it's a running concern, come on, I can enforce my security, even though it is not registered. So until liquidation, you got against the mortgagee, not against the creditors. See, there are two risks if you don't register the charge. One is, if the company goes into liquidation, winding up, the liquidator will throw the document because you are not registered the charge. And second thing, if a subsequent creditor, a subsequent fellow has given the loan on the same property and his charge was registered first, you will lose the priority. When those two things have not happened, come on, it doesn't make any difference to you whether you are registered or unregistered charge holder. So the security does not become void. In fact, the debt becomes payable immediately due to non-registration. Originally, the bank and financial institution has agreed for the term loan that you repay the term loan in 100 installments. Now, because the charge is not registered, they will ask you, forget the 100 installment, you repay it immediately. These are all the consequences of non-registration. Conclusive nature of certificate of registration, very important legal point. Suppose you, please see, you have filed a charge. While you have created a charge in favor of State Bank of India, and a charge is created for 100 crores. While filing the document, the company made a mistake. Instead of 100 crores, they have written as 10 crores. The company nor any person saw the mistake. Or the mistake was done by ROC while preparing the writing in the register or certificate. There was some mistake. And you are saying, so what has happened? That the charge was created for 100 crores, but the final certificate or the register and other details appear only 10 crores. So taking advantage of this, what the company did there, he went to another bank and told, sir, the property is worth 150 crores. The fellow banker has given only 10 crores. And please give another term loan on the same thing, on the having a second charge. Another fellow also gave a term loan. The company went into liquidation. Now, the fight is, the first banker says the charge was created, say they sold all the assets and all bogus assets, they could realize only 50 crores. The first banker says, though the mistake was done, I have given 100 crores, so the entire 50 crores must come to me. If ROC has done some mistake, I'm not bothered. If the company has done mistake, I'm not bothered. But the second bank says, I have given further term loan only on the basis of the certificate of registration. So let this first bank take 10 crores and the balance has to be given to me. What is the answer? To answer this, we must understand what is this conclusive evidence of certificate of registration of charge. Beautifully in the Union Bank of India Chandley case, he says, the conclusive evidence means provisions relating to registration of charge has been complied with. That's all. It is not conclusive of facts and figures. So therefore, who has to be protected? The first banker has to be protected. If this stand is not taken, come on, ROC will make mistakes only, company will make mistakes only. So this also must keep in mind. So the certificate is not conclusive of facts and figures. The certificate is only conclusive. The provisions of the act relating to registration has been complied with. Punishment is terrible. Any violation of the chapter, 1 lakh to 10 lakhs. Officer in default, 6 months imprisonment and 25,000 to 1 lakh or both. Then, if any person furnishes then punishable as fraud. So the charge documents which you file, you do any kind of forgery or wrong information, you will be punished. Fine. So this was the discussion on deposits as well as charges. I will now go to the next chapter, management and administration. So today the half an hour I'll use, and also tomorrow complete 2 hours I'll use. We'll discuss very much in detail, a very big chapter. First, financial year. In the old Companies Act, we had freedom to decide the financial year. It can be from January to December. It could be any other thing. It can be 12 months, less than 12 months, more than 12 months. Everything has been removed now. Now in the present Companies Act, they have correlated with the income tax financial year. So the financial year has to be compulsorily from 1st April to 31st March of next year. But the problem comes in the first financial year because all companies will not be incorporated on 1st April. So what he says, the first financial year may be more than 12 months or even less than 12 months. What is the calculation? See, if a company is incorporated from 1st April to 31st December, 1st April to 31st December, the financial year will be 12 months or less than 12 months. Financial year will be 12 months or less than 12 months. If the company is incorporated from 1st January to 31st March, for 3 months you cannot have the financial year. This will be added to the next financial year. So from this, look at this table. On 1st April, you are incorporated, financial year will be 12 months. On 1st July, it will be 9 months. 1st December, it will be 4 months. 1st January, that next 12 months plus 3 months will be added. It will become 15 months. 1st March, you have incorporated. This 12 months plus 1 month will be added. The first financial year will be 13 months. Subsequent financial years will be only from 1st April to 31st March, correlating the income tax financial year. Then, sometimes it so happens, the holding company or subsidiary company incorporated outside India, they follow a different financial year. Then the holding company has got different year, subsidiary different year. How am I to correlate? Then I want a different financial year. Tribunal may, if you make an application, allow the different financial year to suit with your foreign company's financial year. Let's now start with annual general meeting. Lot of changes have taken place in the new Companies Act. Previously, we had a concept called a statutory meeting. All that has gone. I'm talking of members meeting, not directors meeting. That we'll discuss later. So members meeting are of two types: annual general meeting. Other than annual general meeting, rest of the meeting are called extraordinary general meeting. So every year you have to hold one AGM. What are the rules? The first AGM should be held in such a manner from the end of the first financial year. Just now discussed, first financial year may be 12 months, less than 12 months or more than 12 months. From the end of the first financial year, the AGM must be held within 9 months. So any financial year will end on 31st March. So another 9 months before 31st December, you must hold the first AGM. So if you do the calculation, it may be possible that you may not hold the meeting, a first AGM in the calendar year, next calendar year also. Doesn't matter. So the first AGM from the end of the first financial year, within 9 months you must hold. ROC also cannot give any extension of time for the first AGM. Next, subsequent AGM, the earliest of the 3 dates. 1. The gap between 2 AGM should not exceed 15 months. 1 AGM should be held every calendar year, January to December. From the date of balance sheet to date of AGM, it should not exceed 6 months. However, ROC can give extension of time in A and C cases by 3 months. In A case, if you get extension, it can go up to 18 months. C cases, the gap between balance sheet to date of AGM can go up to 9 months. And if they are given extension under A case, B case need not be complied with. Now, please see an example. The last AGM was held, let us say, on 30th October, in which last year accounts was passed. So first one, the current year, financial year, 1st April 19 to 31st March 20. Then you add the last AGM to this 15 months, that was January 21. 1 AGM every calendar year. 2019 AGM was held, 2020 is 31st December. Then current year, you would have prepared the financial statement from 1st April to 31st March. You add 6 months, 30th September. So invariably, the stumbling block is always 30th September for us. Because from the financial year end, earliest of the 3 dates you must hold. If you take ROC permission, then you can hold up to 31st December. But in the current year, automatically 3 years extension, 3 months extension is given because of the COVID situation this year. So current year, you can hold the AGM before 31st December 2020 without application by ROC. Or put it this way, ROC automatically has given the 3 months extension of time. Next, time, place, and date requirements. A lot of changes have come now. AGM should be held. And these things will apply to private company also. Earlier Companies Act gave a lot of freedom for private companies. Those have been removed. Even today, chartered accountants, company secretaries feel private company is an extension of sole proprietary business, thinking that there are a lot of exemptions. All that exemptions have been removed. So AGM must be held during business hours. And they are very clearly specified 9 a.m. to 6 p.m. You can't hold the AGM in the night time. Business hours, not working hours, business hours. The start should be between 9 to 6. In one company we are seeing, they started the AGM at 5 o'clock. Should the watchman throw them all out by 6 o'clock? No. Between 9 to 6, the starting time AGM can start. It can end after 6 o'clock also. This is time. It applies to private company also. 2, date of AGM. Previously, you cannot hold the AGM on Sundays, festival holidays. All that has gone now, even for private company. You cannot hold the AGM on those national holidays, not public holiday, national holiday. That is the 15th August, 26th January, 2nd October. These 3 days you must not hold. That's all. Or any other national holiday if the government declares. But for that, you can hold on any day, even on Sundays. 3rd, place of AGM. It should be held at the registered office or some other place where the registered office is situated. Suppose, let us say, Nagarjuna Fertilizer holds the AGM at the registered office. Fine. They are expecting 1,000 people to come. There is no space in the registered office. So any other Kalyana Mandapam or hotel within the same town, village or city, that is Hyderabad, Secunderabad will be twin cities. So you can't hold the AGM in Warangal or some other place at all. And there's a clarification, postal limits or municipal limits, wider of the two. For example, you take the case of Bombay. In Bombay, Greater Bombay, if you see, Kurla is a municipality, Worli is a municipality. There are about 30 municipalities in Greater Bombay. And you have got the registered office at Andheri. Can you hold it in Nariman Point, a distance of 50 kilometers? Yes. Postal limits or municipal limits, wider of the two, you can hold. Listen. Earlier, if you got the registered office at Hyderabad, can you hold the AGM in Khammam or some other state, Vijayawada or Bihar, Lalu Prasad Yadav's house? Now, what is the relaxation? In unlisted company, private company or public company, unlisted, you can hold at any place in India, AGM, any place in India, not abroad, provided all the members have given their approval. No 90% or 95%. All the members have given in approval. So in a private company, you want to hold at some other place, but you have to take the approval and you can hold at any place in India. The government may exempt. Some problem is that you have to apply to government for exemption. This place, time, date regulation will apply only for AGM, not for EGM, extraordinary general meeting. Extraordinary general meeting, you can hold on any place, any time at all. The restriction is only for AGM. Why we are attaching so much of importance to AGM? Very simple. Members of the company have no control over management. Members of the company cannot inspect the books of accounts. Members of the company have put the money and they are at the mercy of the directors. So it gives an opportunity for the members to question the performance of the directors. Hence the importance of AGM. Hence the importance of this AGM. What are the business which is to be transacted in the AGM? You all read AGM, the business will be ordinary business and special business. The four ordinary business usually transacted in the AGM are consideration of financial statement, director's report, auditor's report, declaration of dividend, appointment of directors retiring by rotation, appointment fixing of remuneration. But in a private company, that appointment of directors retiring by rotation usually is not there. It depends on the articles. When I go there, we'll discuss. So therefore, in a private company, the three ordinary business usually transacted are this. Any other business which you transact in a private company is a special business. Special business require explanatory statement. Right. What are the consequences if you default the holding the AGM? The company and officer in default, punishable to fine up to 1 lakh rupees, and it will go to 5,000 rupees every date of default. Now, punishing the directors, punishing the company, how does it serve the purpose for the members? Members want AGM to be held. Members want to question the directors. So second option is any member can apply to tribunal. Previously, the power was with the central government. Now you have to go to tribunal. And once you apply to tribunal, the tribunal will give a direction to the company to call and hold the AGM. Still, if the company does not listen, the tribunal itself can call and hold the AGM. Then, if the tribunal is conducting, please see, very interesting. If the tribunal is conducting the AGM itself, because of the carelessness of the board of directors and the company, then tribunal can give extraordinary directions also in the conduct of AGM. They will say, usually the chairman of the board will be the chairman, but they may say, so-and-so person who is not a member, he'll be the chairman. Usually quorum is 3, all this. Tribunal may say, 1 member attending the meeting will be a quorum. So to facilitate easy conduct of the meeting, tribunal can give any kind of directions they want. Tribunal may also say 1 member will constitute the quorum. And tribunal alone has the jurisdiction, no other court or any other person. So 2 consequences of not holding the AGM, fine and going to tribunal. There's one very interesting situation. Some of the unscrupulous company, what they do, they will hold the AGM on time, but they will not place the annual accounts, financial statements, and they will adjourn to some other day. And in the prosecution, they will say, we have held the AGM. And adjournment is treated as continuation of AGM, and they will never pass the final accounts. It will go on adjourn for 10 years, 15 years. So after the Biju Kumar Karnani's case, the High Court made it very clear, if you want, you can adjourn the AGM, but adjourn the AGM also has to be completed within the specified last day. So adjourned AGM also has to be completed, otherwise you are violating. Another thing, suppose let us say 30th September is the last date for holding the AGM. I have not taken extension of time, or I have taken extension of time and that 3 months also is over, I have not held the AGM. Let us say somewhere after 10 days, after the last date is over, I held the AGM. What is the validity of the AGM? It is valid. Even though there is a irregularity, you are punishable for 10 days delay. The AGM is a valid. Very interesting case law. Now we'll go to EGM, Extraordinary General Meeting. If the AGM is not conducted, board will conduct, otherwise tribunal will conduct. AGM, three routes. Normally board will conduct. If the board does not conduct, extraordinary general meeting by requisition, section 100, members themselves can conduct. Then third route is the tribunal can also conduct. So all the business transacted in EGM is special business, requires explanatory statement. Now, calling the extraordinary general meeting. First, the board will normally call 99% of the cases when an item of business cannot wait till next AGM. Then we call the EGM. Any general meeting between two AGMs is called as EGM. So the board, as usual, will convene and conduct the EGM. 2. The extraordinary general meeting, where you should hold it, these restrictions are not there, except for wholly owned subsidiary of company incorporated outside India. You can hold it at any place in India, right? When the board holds it. Listen. Extraordinary general meeting by requisition by the members. The initiative comes from the members. The members want buyback of shares to be discussed. They want sweat equity shares. They want bonus shares, something. Then what the member can do? How many members? Members holding 1/10 of the share capital can give a requisition notice to the board. Or not having share capital, 1/10 of voting rights, they will call a requisition notice. It should be signed by all the requisitionists. Look at these things we are trying to forget. Once the requisition notice is given to the board should convene the meeting within 21 days, hold the meeting within 45 days. If the board does not convene the meeting or hold the meeting, the requisitionists themselves can convene and hold the meeting within 3 months. So for a slight wording says, if the board does not hold the meeting based on requisition, they are not punishable because the requisitionists themselves can hold. But the requisitionists must hold the meeting in the same manner as if the board would have held the meeting. Here the catch. Normally, the expenses for holding the general meeting is met by the company. Thousands of rupees, lakhs or even crores. In Reliance Industries, the annual report cost itself is minimum 20 rupees. I'm putting minimum amount. So 36 lakh shareholders are there. The printing cost is 7.2 crores. So normally, all the expenses for sending the notices, holding the meeting is borne by the company. Here he says, if the requisitioned meeting is not held by the directors, the requisitionists themselves can hold the meeting. They will incur the expenditure, but they can recover the expenditure from the directors. So the punishment is more terrible. Reasonable expenses has to be requisitioned because you are not held the meeting. You will be liable to pay the reasonable expenses to the requisitionists. And the rule says how the requisitionists themselves has to call the meeting. 21 days notice has to be given. Very interesting. You can give through writing. Electronic mode also is allowed. You should specify time, date, and place of business. All those details the rules say. You should also hold it on a day which is not a national holiday. If it is special resolution, explanatory statement has to be given. In other words, you must hold the EGM as if it is held by the board themselves. No concession is given to you. Then now I have to send notices. I have to send the notices. Then how do I know the addresses? So the company, when I ask, they have to supply the list of members and the addresses. And the names appearing in the list of members within 3 days, all that they have to send the notices. Because they have to, I will get the list from the company concerned and I have to send it. Then how I have to send it? Very interesting. By notice by speed post, register post, or electronic mode. Not ordinary post. These are all the rules requisition meeting. Then calling of extraordinary general meeting by tribunal. See, AGM is not held, tribunal is given powers, makes sense. AGM is not held, tribunal calls the AGM, makes sense. In AGM, whenever the board wants to discuss something, powers are with the board. They can call the AGM. When the members themselves want to call the AGM, requisition meeting, 100 rupees there. Why powers should be given to tribunal to hold the AGM? When it is impracticable to call or conduct the AGM. Impracticability depends on facts of the case. Gundaism in the company, Dadaism in the company. The board is fearing to conduct the AGM. Such cases. In case of AGM, who can go to tribunal? Any member. But in case of AGM, tribunal, suo motu on their own or application by any director or member, they can apply to tribunal, and then tribunal, like AGM, EGM also will be held by the tribunal. And they can give ancillary directions also. Right. Now, having discussed this AGM and EGM, certain common points let us now discuss with reference to private company. Notice of general meeting. You are already aware, 21 days notice has to be given, either in writing or through electronic mode. Not less than 21 days means 21 clear days, which means the date of dispatch of notice and date of meeting should be excluded. The gap should be 21 days. If general meeting, what about shorter notice? I can't give you 21 days. What about shorter notice? In case of AGM, 95% of the members must agree. In case of other meetings other than AGM, that is EGM, 95% of members entitled to vote. In case of share capital, no share capital, 95% of the voting rights, they should agree. But then the most important catch point is, in a private company, your articles can provide any known period other than 21 days. This is the advantage. If you don't follow table F, you put your own provisions, these are all the advantage. You can say 14 days notice is enough, 7 days notice is enough. So within that 14 days or 7 days also, shorter notice you can give. So it all depends how you word in the articles. If in a private company, the articles are not there and you are adopting table F, fine, you have to give 21 days notice and follow. Service of notice. How the notice will be given. Again, you write in your articles. Freedom is given in a private company. But I told you the other day, no company's articles take the advantage of the freedom. So if nothing is written, the articles in a private company, then what is the rule? You must send it by hand or post to the address in India. So your duty comes to an end the moment you have posted it. If they have not received, you are not worried. What about NRI and foreign shareholders? You should send the notice only to the address in India. You don't have to send to foreign address. But this problem is sorted out because now everyone has got email, so it will directly reach them. Not a big deal. Right. Now, while sending notice, I will send by hand delivery or ordinary post. But if a member has specifically requested me that please send the notice only by register post, acknowledgement due or courier or whatever it is, and he has deposited the expenses to the company, you must send it only by register post, speed post or courier. Otherwise, he'll go to court and get the meeting invalidated. You can't say, no, you send it, I'll pay. No. Please see, normally at the annual general meeting notice or in notice, I'll send it by ordinary post or hand delivery. No register post. But if a member is requesting that please send me by register post, speed post, courier, even courier, and he has deposited the cost to the company, you must send it accordingly. Otherwise, it's not proper service. Now, if you are sending by post, 48 hours is to be added. So how do you now calculate 48 hours plus 21 clear days, unless your articles provide for something different? What about joint holders? You don't have to give to both the joint holder, that holder, the first holder, if you send, that is enough. Suppose some of the members in a private company have not given their addresses at all. Then I cannot keep quiet. You just give an advertisement in that local area, then it is equivalent to sending the notice to his address. But while giving the advertisement, you don't have to give the explanatory statement or all in the advertisement. Then some more rules. I can now send by electronic mode. All companies, even private companies, can give electronic mode. Email notice I can send, provided you keep proper record of the communication which is addressed. It can be sent by attachment. All these technical things are there. It is now permitted. The company should be satisfied, transparent. They will not be responsible for failures. You keep proper records. Some of them may not have reached. It is the company is not responsible. But if you send it by email, even in private company, you have to place it in the website. It is only optional. It's not compulsory you send it by email. But you can avoid a lot of expenditure, cost and all. Email is almost practically easy, for practically it's a nil cost for you. But you have to put in the website. Entitlement of notice. See, small points. Again, in a private company, your articles can decide whom to be given, whom not to be given. Obviously, you have to give it to every member because it's a member meeting. But in the absence of your own articles, provisions, what the law says, give it to every member. Preferred shareholder also is a member. So you have to give notice to preferred shareholder. Legal representative of the deceased or assignee. The other day I told you, legal representative in case of death of the member or official assignee or official receiver automatically will not become member. If he wants, they can become member. Otherwise, automatically, I've been telling you, he will not become member. So what is the position of the legal representative, official assignee, receiver? They are shareholder, not a member. But they can receive notice of the meeting, even though they cannot attend the meeting. Look at the fun. Then auditors, the new act says you have to send notices to the auditors along with the complete annual report, notice of the meeting, director's report, financial statement, audit report. The question now arises, sir, why you have to send all these documents to the auditor? He is the originator of all these documents. Don't you think he'll be having a copy of the audit report, director's report, annual accounts? Off record, this is a cross check. He can see whether only those documents and figures which are original is sent to the members. So the law says send everything in the notice to the auditor, every director, a catch point. Let's go deep and understand. First point, has a director of a company inherent right to attend the members meeting, AGM or EGM? If a director is a member of the company, is a shareholder, his name appears in the register of members, then he can attend in the capacity as a member. My specific question is, can a director of the company who is not a member, who is not a shareholder, attend the AGM or EGM? No, no, and no. Nowhere it is specified in the Companies Act. Of course, chairman will call him to come and attend the meeting. He will attend with the permission of the chairman. I witnessed one company. There were some allegations against a director. One of the members stood up and said, ask this director to go out. Chairman said, no. Then the member said, is he a member? No, ask him to go out. Chairman had to comply. So the beauty is, issue of notice is one issue, attending the meeting is another issue. Don't combine. So here a director is entitled to receive the notice. If he is not a member, he cannot attend the meeting. Here, legal representative, this is official assignee receiver, is entitled to receive the notice, but since he is not a member, he cannot attend the meeting. So look at it very carefully. Then, if the company has issued the debentures and all, debenture trustees will give notice. Very interesting. Beneficial owners. Tomorrow probably I'll be discussing that. L. Jayaraman is the member, but I've taken money from my brother. My brother is the beneficial owner. Will he have any rights? No. L. Jayaraman, the member alone, will be recognized, even though I may not have beneficial interest. I'm just a trustee. That those things we'll discuss tomorrow. Then, what about preference shareholders? Normally, the articles should provide preference shareholders will not be entitled to receive notice at the meeting. You have to provide. But if the preference shareholders have voting rights, the other day we discussed, if the dividends was not paid last 2 years or some of the resolution, then you have to give notices. So otherwise, you don't have to give notice to the preference shareholder. This you have to specifically write in the articles. Otherwise, they are entitled to receive notice and attend the meeting. Then, very interesting. You should have read in the board meetings, every director has to be given notices. If any director proves he has not received the notice, he can invalidate the proceedings and declare the resolutions passed as void. But in case of general meeting, accidental omission to give notice or non-receipt thereof will not invalidate the proceedings. Yes, very logical, very reasonable. Take the case of Reliance Industries, you have got 36 lakh shareholders. So it's possible, maybe 1,000, 2,000 notices were not sent, fiscal notices. Some were misplaced in the post office, some were not properly delivered. A lot of mistakes can happen. So what they say, accidental omission to give notice. If it is a purposeful omission, then it will invalidate the proceedings. For example, say in a private company, there are 180 members. You have printed itself 75 notices, then it is accidental omission. Then, failure to send the notice in the belief that address is not, these are not accidental omission and all that. Then, notice of adjourned meeting. Normally, no notice is given for the adjourned meeting because no new business is discussed in the adjourned meeting. So the old, but if the articles so provide, or you have adjourned sine die, that means without telling when it will be resumed, and then you must send notice for the adjourned meeting also. So that's why you write all these provisions in the articles regarding notice, contents of notice. Please attend the general meeting. For details, contact company secretary. You lose your job. The law beautifully says, not only notice must be given, the notice must specify the time, place, date of the meeting and business to be transacted thereat. And we already discussed the business will be in AGM, ordinary business and special business. Special business requires explanatory statement. Similarly, in the EGM also, all the business will be special business. It requires explanatory statement. But in a private company, come on, you can add something more also regarding contents of notice. So thank you very much. So we'll continue the session tomorrow. As I told you, tomorrow finish off. The timings will be from 3:30 to 5:30. Thank you one and all for your patient listening. Back to the chairman. Thank you, sir.
Thank you, sir. Thank you very much for the detailed explanation on the charge creation, deposits, and other financial statements and everything. Really, that was a splendid explanations and also in an elaborate way. Thank you very much. My dear delegates, I don't forget about tomorrow time. That's a bonus session given by our sir, Jayaraman sir. At 3:30 sharp, it will start and it will end by 5:30. Okay, I request everyone to kindly attend the same. The link was already shared to you. There is a separate link which will be shared to you, not a regular link that will be followed, because it is a unusual thing that what we have planned. So it won't require any registration. Just press the link and then you will enter into the Zoom. That is the only thing. That's all for the time. Thank you, sir. Thank you very much. And we're calling for the day. Thank you.
Thank you.